This is our second in the series of 3, as AJ mentioned. And again, definitely the case that it's very interactive. We haven't got a large number of people on the call, so I don't mind taking questions. And as mentioned, if I can answer the question there and then, I'll do it. If not, I'll save it for when the relevant slide comes in. Or if it's a bit too much for this particular forum, I can always take it outside, or we can have another session on it later on. And so for those who haven't been on the previous session, my name is Yogesh, and I'm providing, so again, just a quick disclaimer, just a general guide on how to deal with setting up a business or dealing with startup matters in accounting and tax perspective. And I think we are budgeting around 45 minutes to an hour. So we've got quite a lot to cover, but at the same time, I want to make sure everyone walks away feeling happy with what they want to come out with. So one of the things I picked up from the last time session was share cap tables. And because some of you may or may not be in the future raising finance, I just want to give a few pointers here to help people understand, so they're not feeling a bit nervous when people talk to them about diluted versus undiluted, or understanding how employee share pools work. And then the main part of the webinar will be things about why we use Excel versus bookkeeping for the cloud accounting systems for dealing with the finances. And I'll talk a bit more about how to put the entries in if you were using Excel, or how automated things can become if you go down the cloud-based route. I do also want to touch on VAT, because that does interact quite a bit with the cloud-based accounting and whether you still stick to Excel. And finally, just so you guys are all understanding, what are the requirements for yourselves as you start a company. So if you set up a company, when you do, what are the requirements from Companies House, HMRC, and any other potential legal issues that you may want to consider. And I've got questions at the end, but again, feel free to put them down on the chat box, or just give me a shout. And feel free to unmic just a very quick profile about me. So I am the founder of Telic, which is a tax-focused accountancy practice. We also try to focus on purpose-driven entrepreneurs, so people who are driving social change, but also who are looking to grow exponentially. A bit about me. Again, I'm LSE alumni, ex-PwC, and I've got a ACCA and CTA certification, qualified, and got a young family of 2, and I enjoy some cycling and running. Right. So again, as last time, I did set the scene with a few photos, and I thought I'd do the same this time round. The key point here is saving yourself time, and also versus how much stress should you put yourself when it comes to worrying about all the company reporting. So these are sort of the 2 themes you'll see resonating through when I talk through some of the technical content about you either need to worry about it or not, and if it's too much of a worry, whether you should be doing it and spending time doing it, or outsourcing it, or thinking about another way of doing it. Right, so jumping on to straight into share cap tables, understanding diluted versus undiluted. So before I jump in, any show of hands or any sort of noise, whether or not people know what this is, will be quite handy. If not, I will just jump straight in. Yeah, okay. As always, quite hard to gauge people's reactions on Zoom, but I will try my best. Right, so what I'm trying to explain here is the main point is when you are raising capital, let's say, again, just like last time, is anyone about to raise finance? Maybe we do use a live example so someone can get some real feedback from this session. Is anyone about to look to raise a few £1,000s or give away some equity? Otherwise, I'll just use a fictitious example. Any takers? No? Okay. Right.
Yes, so, I raised. Sorry, Yogesh, I raised my hand. Hi, how are you?
I can't see you. I can't hear you. Oh, Alice again. Hi, are you okay?
Oh, let me open the camera. Yes, I'm good.
Okay. Yes. Right. So, so I remember you were looking to raise money quite soon, right?
Yes.
Okay, great. So you don't need to give me actual numbers if you don't want to, but how much equity are you looking to give away?
We're in the process of calculating that, so
Okay,
this is
great.
going to help.
Yeah. Okay. Perfect. So let's just. I'm actually gonna. I've got an Excel spreadsheet with an example. I just thought would be useful to talk through. So you may create something like this for your own share cap table, right? So what you have here is, let's say there's you as Mr. and Mrs. Founder, Miss Founder, whichever, right? At the moment you own 20% of the business, but in theory you probably have how much of the business? I think it's you and your co-founder, right?
With 3, so we have 33.
Okay, fine.
Point something.
Yeah. So for now, I'm just going to see if I don't want to change the numbers too much, and then they take too much of everyone's time. I think, assuming, for example, you right now, I'm going to change. Okay, what I can do actually, if I just delete all these. Yeah, so you got 60. I'm going to keep it simple. So let's say at the moment you own 20% of the business. Just hear me out for a second. But you've also got these shareholders as well already, right? What happens is that there's a thing called employee share option pool. So what happens is that you may have some key employees in the future that you may want to bring in. But the thing is, you want to sort of let your investors know this before they jump in, because let's say they think they're going to get 10%, but actually in reality they're only getting 9.5%. And that's quite important to be aware of, because what you don't want to do is tell your investors that yes, you're coming in at 10%, but then a few months later you need to have your chief technical officer and your chief COO coming in, but you want to give them say 0.5% or 5%. So what you say, you actually flag in the shareholders agreement that within this agreement, even though you've got effectively on an undiluted basis, so a diluted basis 9.5, and the current basis you've got 10%. So as and when in a few months' time, say you've issued these share options of 1%, 1%, 1%, the 1% kicks in here, but then you can see here these shareholders they've actually got a lower shareholding. So I'm just trying to show you the mechanics. So right now I've just copied and pasted these two share cap tables together. So one is called undiluted and one is diluted. And these two terms, you need to be quite familiar with, because a venture capitalist might ask you, is there a dilution? Is there any dilution I need to be aware of? Or you can say, well, possibly, because I may be looking to bring in some key employees. And so you also show them this share cap table, which shows that you've got key person 2, 1, 2, 3 here, and you may have an extra share. So in total, you're saying roughly just 5% will be allocated to a share option pool. And what that does is that reduces the shareholdings across the other shareholders. So remember before, Alice, we had 20% here, yeah? I would change the numbers, but I don't want to create the formula changes right now on the call in case they create issues. So let's say you can see where that from 20 goes to 19. So what we're trying to say is that in the future, you will get automatically diluted by 1% because you've created these new share option pools. And it's an education piece to all your founders that don't just assume that an investor comes in at 10 and they stay at 10 on day one, because you've told them that you're going to potentially have a key person share pool, so that they don't say to you, well, hold up a minute, I came in at 10, why am I now 9.5? This is separate to a further equity round. So let's say, Alice, in 6 months down the line, you raise even more funds because you finished all the cash from day on the current fund, then that 10% may go down further unless they want to exercise their preemption rights. So I think, let me just say the question, do you really need to plan and show dilution for future rounds too, or just so? I think that question just came in whilst I was answering the question. So what it is, there's a whole, does anyone know what preemption rights are, or shall I explain that? I will explain it, but just to get a feel for the audience in the group. Right, so Alice, I've got a straight face from you, so I'll explain it. So preemption rights. So what happens is, let's say I'm a shareholder of yours, and I find that I've invested, say, £10,000, and I'm this person here, right? So let's put Yogesh. Oops, not there. So I'm here, investor 2, and then so I've got 10% of equity, and I've got £1,000 of shares, 1,000 shares. But then 6 months later, you need to go and raise more money. So because I own 10% of the shares, let's say you go and raise £100,000, right? So first of all, you can go, you have to, normally as part of your shareholders agreement, I will have preemption rights. As an investor, I would always want to make sure that I don't get diluted without being asked first. And that's called a preemptive preemption rights. So what happens is that before you can go out to market, you need to go to your shareholders and say, by the way, I'm going to issue new shares. Do you want to come in? Do you want to still participate? And normally it's on a pro rata basis. So on that basis, because I own 10%, I can then invest at least 10% so that my shareholding doesn't get diluted. If I don't invest, then somebody else will come in, say investor 9, so say it's made up of a person, Sam, they come in, and then my shareholding will get diluted, because how else will you generate those extra second round of funds? So the whole concept is all mathematically driven. If I come in, then my 10% doesn't change. If I don't come in on the second round, my 10% will be reduced by a few percentage points, similar to the way this came in. You see the way that went to 9.5 compared to 10, where it's the same concept. So I just use employee share option pool because it's slightly more technical compared to just going for another seed round. Because, I mean, if you remember the whole story with Facebook, Zuckerberg stopped, I think he created lots of shares and he diluted the original shareholder. I forgot the other partner's name, but that's how he basically wiped that 10% or whatever percentage of his co-founder down to 0.0001%. So this is the whole concept of dilution. He didn't have preemption rights clause possibly in the paperwork. So as an investor, I always want to protect myself to make sure that I don't get completely diluted. So hopefully that gives you a bit more of a rounded answer to your question. But yes, you do need to think about dilution, but it's more of the investor's concern, because if they don't participate, then they slowly reduce their shareholding. But that's not a bad thing. So, for example, I'd invested in a company before where I was invested at the beginning, but then a few months or a year later, they done the second round. But by that point, it's quite handy that they're doing a second round, because that means they're doing well, or there's people apart from myself who want to invest in them. So even though I'm going to get my shareholder dilution, hopefully the value has gone up because someone else is coming in, and the value. So when you now go for that second round, there'll probably be hopefully a higher valuation, because mathematically you're going to make sure that you don't get diluted too much. So you're going to have a value quite higher than the original valuation. So I mean, it may be worth a whole other session on valuation piece. I can debate that with LJ at some point, but technically it's very important to understand the valuation side of how much you increase the value for your second round or third round of seed funding versus how does it impact the actual shareholding. So I just want to give you that insight from a basic perspective between what is the cap table, which is this. This is an undiluted basis, and this is an undiluted basis. Okay, hopefully that's helpful. Now, yeah, so I talked about investor consideration, the founder consideration, the same thing. You will also get diluted, Alice, as you go down the route of getting new funds, unless there's a different way of structuring it, or there's in simple terms, every time you raise funds, this shareholding percentage does go down. Otherwise, the math doesn't work, and you're not sharing the pie.
Can I just quickly add on that, on my question as well? If we have to plan for and show, which I understand, and show investors of the, let's say, the pre-seed round, that they will get diluted, how can we plan actually how much they will get diluted? That's that, because with the employee option pool, it's easier because you decide how much equity you want to give them. But with the future rounds, I mean, does it mean that like from today I have to plan like every round from 18 months and then 24 months, etc.?
It's a very good question, but if you're going to think about it from a practical perspective, let's say you were, I don't know, let me think about a successful startup, Zoom, for example. When Zoom was first, people started jumping into it. They would have put in, say, 10%, 5%, 1%, 2%. But then in order for them to raise, say, another 100 million or 10 million, you wouldn't have known at that point how big the company could become. And so you can never know how much money you're going to raise and what value that will be. So as long as you've got it so it's fluid in the shareholders agreement that any equity raise, there's a preemption right where the investor can jump in. If they don't jump in, then they'll just get diluted. You don't need to give any obligation that, oh, by the way, I'm sorry, but you will get diluted by 0.this% now. And that, because effectively, you don't really know, because it will depend on two variables. One is the valuation, and the other one is the number of shares issued. So I think I might even do something about that, depending on how people develop or feedback from them and LSE General in terms of how people understand that particular point. But to answer your question, it's like a crystal ball. You'll never know the value until investors should be aware of that on that concept. Okay, fine. So,
thank you.
No worries. Thank you for the question. Accounting and Excel. So, right. So you may have seen the slide from last time. So many of you are still embarking on your journey, or you're about to embark on setting up a company. And I did say last time that you don't always need to jump into a company, or you don't always need to go all full out on your cloud system, because one, it may create additional costs. You may not have enough transactions to even merit a big cloud infrastructure. So it could be as simple as you creating an Excel cash book, which keeps a record of your transactions, and I'll show you an example of that in a second. Yeah, I think, yeah, I'll just bring it across 1 second. So what I've done here is, I think I showed this to some of the people here in the last session, but I just want to give a bit more airtime on this session, because I think in simple terms, I found a lot of people just get worried or stressed about how do they manage the accounting, how do they manage the transactions that they generate in the bank or outside the bank. So what I suggest to clients, especially if they haven't got many initially, and sometimes you find that there aren't many. For example, when you're just starting out, I'll just use Alice as an example, where perhaps before they set up the company, they had a few website developer costs, they had a few Google domains costs, LinkedIn subscription costs, and they didn't have a bank account set up. So what's handy is that you just keep a record of it here, and then keep a Dropbox or some sort of receipts library, and then in case HMRC were to challenge, you have the receipts somewhere centrally. But more importantly, you're able to create sum totals of the key expense items without it creating too much of a headache at the end of the financial year. So I don't, if this is going to be, say, 500 lines long or 600 lines long, I wouldn't recommend this option. But what you don't want to do is, end of the year, fine, you say you set up the company today, and end of the year comes, and you've got to go through all the emails and goes through a lot of paperwork to get here and your bank statements. And you're getting an accountant to prepare your accounts, they will charge you more because it's a lot more onerous to help you prepare the accounts. So this exercise I'm going to spend 5-10 minutes on is to help you keep your fees low for any sort of accounting services if you were to take it on to do for someone else to do it. So I've got some examples here, some travel costs, a website cost, and a printer. And I've got sales line. So I just go to the printer one. So let's say you just started out and you're working from home and you've got this new business and you're using your printer purely for your company, and strictly speaking, it's a fixed asset. So I've got here fixed asset lines as well. So what you're doing is you're creating a bank entry in here, and you're putting a bank, but then this is a check. So this is called different nominal lines. So in your accounts, you have all these different basically subheadings, which are called nominal ledgers. And you'll see here the printer is 100. So let's say you've only spent £100 in your fixed assets during the year. So you'll see at the end of the year there'll be £100 for your accounts that your accountant or whoever else can do, and they can put £100 for fixed asset additions. If there was a loan, so let's say you've got a bounce back loan from the government, then similar story, you'd say 2 days, and then you just put the narrative down going. I mean, it's quite basic, but I'm just trying to give you a framework in case you don't want to go down the route of a cloud-based system. So let's say you've got 25,000 from that, and then again, this is just a check system here, and then you can see right now you need to allocate that to the loan. So I'll put loan here, 25,000. Yeah? 1 second, that's negative. liability. So yeah, so that's the entries. Again, I mentioned this to everyone before, so the last call is very important that sometimes a company doesn't have a bank account. Sometimes you create expenses before you incorporated. So don't lose track of them. Put them on the system as well, on the accounts. And then later on, when you do the accounts for somebody else, it's quite quick to work out what is the liability owed to you as a director. And again, your sales invoice and other receipts. So I think you can see it's not rocket science. I don't just spend too much time on it, but I just want to show you that just having something like this simple will help you keep a track of your costs and your sales. So again, I just mentioned sales quickly. So that was sales. Yeah, sales to say Jack, and then that goes to the side here. And then the reason why I've got sales here is because, and I'll talk to everyone about VAT in a second, because you'll need to think about if your sales hit a certain amount, you need to register for VAT, but I'll come on to that in a minute. So I'm just going to switch over to the Excel side, so the Xero and the cloud-based system. Is there any questions on the Excel, or can I move on? So I just pull up my basic Excel Xero demo. Okay, right. So it looks like I haven't got any questions. So I'm going to move over to the Xero or back to the slide deck. So you can see I talked about how it works, and then I've talked about how you can account for your fixed assets and your director's loans, all very basic. Now, it's a very different approach when it comes to putting things in the cloud. And in hindsight, I do recommend clients. So if you are looking to grow very quickly, or you don't want to spend too much time dealing with Excel, then it's worth setting up things in the cloud. So it's a lot easier to manage. And if you feel that you want to keep things, very watertight right from the beginning. However, it does require a bit of setup time and making sure that you're disciplined to reconcile. So what it is, there is an ecosystem that helps drive it. When I say in the cloud, this could be, and how it works is, think of Google, whereby you have Google Drive, where everything everything goes into the system, your email system, your website domain. So your Xero or your QuickBooks is your sort of main data set, your mainframe where all your accounting systems sit. But then you can have other things coming in through APIs such as Receipt Bank, Stripe, Go Cardless, Tango. So these are just examples of API apps that can integrate well within your accounting system. So this allows you to have slightly better reporting on a live basis, but also things like Go Cardless, some of you may or may not know, or Stripe. These are payment systems. So when I issue an invoice, for example, I can get the client to pay directly on the invoice by clicking Pay Me or Pay Now using Stripe, or Go Cardless, where they'll have direct debit set up. So what I'm trying to say is, with Excel, you'll just issue an invoice to a client and you just hope they pay at some point with a bank transfer. So it's very sort of the old school traditional way, which is completely fine if it works right now for your setup. But depending on what services you're providing, whether it's through Shopify or whether it's the retail side where you're using some sort of tech-based system, you will need to use Stripe to help you with that. And the good thing is Stripe can integrate very well into Xero, and that can map a lot of your invoices or your receipts for payments. Again, I'm sure you're familiar with TransferWise. You can create live bank feeds into Xero. So I'll move over to that now. So I'm going to use Xero because I use Xero more than QuickBooks. But I know compared to last time's seminar, a lot of people have been using QuickBooks, mainly because there were a lot of adverts on TFL at that time when they were setting up a company. So they're both very good. Actually, they're both really, really good. So it just depends which one you prefer. I generally historically found that the user interface is slightly cleaner on Xero. Again, they both do the job just as well. So I've just gone on to a demo company, and what I want to show everyone is that my Excel tab, if you remember, had that first tab showing the bank entries. But And what the whole concept of online cloud feature is that the bank feed comes directly into your accounting software. So that's quite a revolutionary thing from an accounting perspective compared to, say, 5-10 years ago, where accountants would receive a big wad of bank statements and then they'd ask the client to send another big wad of receipts and payments. So those days are over. Hence why I'm more interested in helping clients with their accounts, because we can do this in a more cost-effective solution, but also the client can be a bit more hands-on and do it themselves. So you can see here the various examples like city limousines, smart agency. These are all every day the bank fees will just come in, and then you'll see here these are invoices that have been created in the client system in Xero. So I'll just open this up. So you'll see here within Xero, you as a client, you as your entrepreneur, you've gone onto here and created a new invoice, and that invoice will be sent to the client either directly via the accounting software, or you download it by print PDF and then you send it to the client. And the beauty is, because the invoice is already in the system, the software, it's got some sort of AI built into it. It knows straight away that Ridgeway University bank feed corresponds to Ridgeway University invoice. So it tells you, look, I can tell that this number here matches this, the amount, the invoice payee also matches. So you know what? You can reconcile this. So hey ho, click OK. So what that means for anyone who knows some understanding about accounts, that's posted into the accounting system as being paid. Your balance sheet liability debtors goes down, and your cash balances goes up in the account. So you can see how automated things become as long as you stay focused and you have a good disciplined approach to keeping it maintained. So this is why this could become quite a horrific number if you leave it for a long time. Whereas if, for example, I'm going back to Excel, if, for example, for 6 months you only think you're going to have 5 or 6 transactions, you know that you'll have a few direct expenses, you may not want to go down the Xero route or QuickBooks because it's extra staff that you don't need, especially if you're not VAT registered. So, whereas if, for example, you are selling products online and you're getting a vast amount of orders, then you may want to set this up so it's connected to your Stripe or PayPal account, and you can quite easily do a bit more of a reconciliation exercise, whether you or an accountant can manage a lot easier. Any questions on that? I know I'm going quite fast and I can't gauge whether this is useful for anyone because I don't know what stage they are at in their current journey of dealing with accounts. Otherwise, I'll carry on. Yeah, okay. So going back to the process here, you can see it's quite a handy tool having the bank fees coming in. Right, so if I now go back to the Excel yeah, so I mentioned direct bank fee, which is very useful. So I've got clients who have got 5 bank accounts across multi-currencies, they also have PayPal, Stripe, all these different transfer-wise, and that can create quite a lot of complicated. You can never do that on Excel; it will take you ages. So all of a sudden, being in the cloud allows you to be more flexible, and you can quickly reconcile. And not only that, you can then easily do a P&L. So let's say you want to get a snapshot of your P&L as at the end of January, or even now, subject to any unreconciled items. So you can just do this quarter, I'll just do this month, so pick up date, and you can quite quickly get a feel for the sales and costs, and you can have budgets on here. So it's a very useful tool, especially if you're going to have investors come in and they want to see how you're doing, and you want to give them a quick snapshot. With having it in Excel like this, it becomes very difficult, whereas having it something like this in a way which you can quite easily turn around, get a feel for what's the rent this month and last month, or last month and last year. There's a lot of flexibility here that allows you to do this with software on your side. So I just go back to the PowerPoint. So we talked about direct bank fees, invoice generation and automation. I touched on that just now, where the beauty is you could have a recurring invoice. So I've got clients where every month I'll invoice them a certain fee, and I don't need to go to my Word document, create a new invoice. It's all automated, so each month they'll get an invoice from me generated by Xero, and not only that, I'll make sure they're set up on Go Cardless or Stripe, so it's paid automatically, so it's like a direct debit on their side. So all of a sudden, I don't need to speak to them each quarter or month to send them the invoice or even email them. Not only that, they don't need to do anything on their side. It's set up on direct debit. So that's quite a useful way of managing your cash flow, managing your finances, and automating it. And again, you can't do that with Excel. You can do that with a cloud-based software, accounting software. API. So again, you can connect a lot of APIs to Xero and QuickBooks. There's a whole marketplace. So let's say, for example, you've got a property letting business, or you've got a retail Amazon-based business. You can connect your transaction lines into Xero, into QuickBooks. So things become a lot more automated and very powerful, quick to analyze data. Now, I'll come on to VAT and making that just on a separate slide. The accounts, again, I mentioned that already, where you can help, even though with Excel, yes, this is great, because once you've done the year end, you'll have, say, 50 to 100, 200 lines here. Your bank will reconcile, all these lines will have the total sums of your freelance wages, your rent. And the beauty is you can just give that to an accountant, or you can do it yourself, the accounts, to a certain extent, subject to the disclosures you need. But the beauty is a lot of work, a lot of heavy lifting of bookkeeping is done. Right. So let me. So I'm now going to just touch on VAT, because I appreciate a lot of you are now still on your early stages of setting up the business. But VAT will become a very important factor to consider. One, to potentially reclaim expenses, VAT on expenses, so you get a big cash inflow on the first return, or you've got to start charging VAT on your sales because you've reached a certain threshold. I just want to make sure people, I'm just going to try and get some interaction here. So who has not heard, who's not familiar with the 85,000 threshold for VAT? Right, I heard some noise, that's great. I'll take that as a positive. Right, so in terms of VAT, what happens is if you've generated turnover, say first month is 5K, second month is 10K, right? You don't need to register for VAT. You can do it voluntarily, but that's only if you can register voluntarily, but that's only if you have a large amount of expenses you want to get a refund on your VAT. But I'll come on to whether you can do that later on. But most people, when setting up a business, especially if you're business to consumer, and I'll repeat that again, if you're business to consumer, then VAT will be an issue because the consumer will be subject to 20% the minute you are VAT registered. So that's very important. So let's say, for example, I've just set up an online business and I'm selling via Amazon. Right now, I don't need to charge VAT because I'm not a VAT registered company. But then once my threshold hits my sales hits 85,000, either over the next 12 months or in the next 30 days, there's an issue, right? I think that should actually be over the last 12 months. I just got a slight typo there. What happens? You've got to make sure that over the last 12 months to date, your sales not more than 85K. Once they hit more than 85K, you need to VAT register, and you need to start adding 20% on your VAT return. And the reason why I'm bringing this up with the linkage with cloud accounting and cash book, because you will then need to make sure you're quarterly reporting to HMRC your VAT return. And this is where cloud accounting gets a bit more easier to manage the VAT prospects of it all. And so one thing I tell clients sometimes is that if you're just starting out, you haven't got that many expenses, and your sales are very low, you may not want to go down the cloud route. But the flip side is, let's say you are generating a lot of cash and you've got sales of turnover of more than 85,000, then you want to start thinking about being on the cloud, because then you can easily submit your VAT return through the cloud accounting software. So you can see quite easily, you can do a period. Again, because it's a demo data, I can't easily show you everything, but I'm just trying to give you some heads up on how this could work. But the key point is you can see it's quite easy to create the data that you need for the tax and VAT return, whereas with Excel, it will require you or an accountant to spend more time pushing the relevant figures into the VAT return, working out what's VAT applicable or not, whereas all the invoices won't be for now, but then in your cloud accounting software, you'll be automatically putting, say, a printer, it'd be £80 plus VAT, and that will be already in your system. Yep. So that's a key benefit from a cloud accounting system, whereby you can use all this technology to help you rather than spending time each quarter, one, having to reconcile your bank, and two, missing any payments, but three, it's all captured here. Okay, so I'll just jump over back to the slide deck. Yeah. So I think as part of the concepts here, the main thing I also want to flag is when you do become VAT registered, a big planning point is there's two ways of accounting for your VAT. One is on a cash basis and another is an accruals basis. So I think that's quite important, because on a cash basis you can benefit quite a bit, because some people have been caught out where they just go down the accruals basis, which is effectively the normal route. Whereas cash basis, what you're allowed to do is you only pay VAT when the money is received. So that's very important. So let's say you should invoice to a client. Normally on an accruals basis, which is the default method, which is a normal accounting treatment for P&L, is every the minute you issue an invoice in your account, that will create 20% VAT to be payable to HMRC on the due date. Whereas in reality, when you issue an invoice, you don't normally receive the cash straight away. You have to wait until you get the cash, and then you've got cash in your bank to pay for the VAT. So what HMRC have done is they also allow you to file your VAT return on a cash basis. That's quite important to know the distinction. One is more favorable for helping you manage your cash flow. So my suggestion here is that when you do have to end up being VAT registered, do opt into a cash basis if you have very lumpy cash flows generation from your invoices. And the same principle applies for expenses. You only have to repay, include the expenses in your VAT return once you've paid the VAT. So that's quite an important planning point to consider as and when you become VAT registered. And there's another thing called the flat rate scheme. So I won't spend too much time on that, but again, it's a huge cash flow advantage for small businesses, whereby, as you're aware, when you become VAT registered, you'd have to charge 20% to your clients, generally the UK clients. But what HMRC are saying is that we'll only charge you 4% on that rather than 20%, and you can keep the difference even though you've charged 20% to the client, to the customer. So it's a very favorable system for early stage companies as they develop. I think it's like 250 or 150k. Anything above that revenue, then you can't use the scheme. I just want to flag it in case there are some early startups who will find this as a very useful cash flow advantage. But again, the reason why I'm bringing this all together is because with the cloud accounting setup, it's a lot easier to manage your VAT return and dealing with your bank reconciliation on a quarterly basis rather than dealing with it on Excel. Right, so I'm conscious of time. Before I move on to the next topic, does anyone have any questions or any thoughts?
I actually do have a question super quickly.
Yeah, sure.
If for an early stage startup, so pre-revenue, what would be the benefits of registering for VAT? And I'll tell you what I have in mind. If we're still paying expenses, right? So we're still paying VAT on expenses. So it's paying, but you can't claim it because we're not VAT registered. Are there any benefits in actually registering for it, or would the downsides actually outweigh the benefits of doing that?
It's a very, very, very good point. I'm glad you raised it, because the whole concept of VAT is that once you start it, you're kind of stuck with it. Every quarter, you've got to spend time doing it, and it's an unnecessary burden for an entrepreneur to deal with. And so if you can avoid it in that respect, it's ideal, but you're losing out on the cash flow benefit from the expenses. So I think because it was a service-based business, from what I know, there are rules such that once you register, you can go back 6 months and claim any expenses in that 6-month period. So there's a few things I would suggest on that, because it may be that you're going to be spending more money over 6 months and you're still not registered. So bear that in mind, first of all, so you can't claim back the old expenses. I mean, it could be things like you may want to think about, it's possible, I'm not sure, but whether you can ask the client to delay your supplier to delay the invoice if you think you're going to be invoicing soon, so registering within that 6-month period. But the whole concept is that for goods, if you are just so you're aware, anyone else, if you are in the business of dealing with goods rather than services, which generally at the moment with all the tech businesses going around, they're more service based. But with goods, if you're buying and selling goods, you've got 3 years of pre-registration expenses to claim. So there's a big distinction there: 6 months for services for pre-expenses registration, or 3 years. But going back to your question, Alice, you lose out if it's more than 6 months, but you can claim later on, even though you haven't registered yet. So it's a sort of thing. It's a way up, a toss up between, do I start now filing nil returns? You may not have sales for say a year, but each quarter you may have expenses that you want to claim. So depending on your background, or you're willing to sort of go to Excel, do the accounts and do the VAT return, you may, if you've got a huge amount of VAT you want to reclaim and you're getting close to that 6 months, you can voluntarily register. So you don't need, and going back to my previous point, you don't need to wait for the 85k, you can voluntarily register. But again, we don't always recommend it, because then, especially if you don't want to do it and you want an accountant to do it, over time you find out the cost incurred to actually do the accounts. And there's also penalties if you don't file, and fees are, so there's benefit there. If you're trying to save £500 or £300 for those old expense claim on the VAT, you may just want to let go and not do that. Okay, no, thank you for the question.
Thank you.
Okay, right, so yeah, so we've got a few more minutes, so I'm just going to keep cracking on. So on the topic of the seminar was how do you and I'm thinking about those images I talked to you about, the stresses versus the time. So so I think the key point here is that, yes, when you set up a company, there's lots of things to think about, but big picture is they're not immediate. You don't need, if your year end is say 31st of December, you've got 9 months to complete your accounts. So there's a long time. That doesn't mean you just forget about it, but you plan. You plan enough so that you can get the accounts filed within a few months after the year end. And also use your Excel spreadsheet on a regular basis to update things, so it's not too onerous at the end. I mean, I'm sure it's sod's law for many of us where we do things in the last minute, but at the same time, it's important to have keep that spreadsheet as accurate as you can, or just keep a folder with all the receipts, so that when it does come time to doing the accounts, you have that information available. So I just wanted to go through some of these headline points, just so you're aware what is required. I appreciate some of you will know this already from the previous session, but I'm just going to give some more detail on it. So the key point here is that Companies House 9 months and 1 day for filing your accounts. Corporation tax is 12 months. But what's very strange is that you've got to pay your tax within 9 months after the year end. So it's a very strange thing where you've got to know how much tax you've got to pay 9 months after your year end, but you've got to file the tax return after 12 months. So it's a bit like, how can you know how much tax you've got to pay until you prepare the tax return? But they're giving you 3 extra months to file it. So what we do with clients, which is more practical, is that we just do it all together before the 9 months. And I would suggest you do the same if you were to do it yourself, that within 3 or 4 months after the year end, don't leave it too late, and just make sure you've got your Excel spreadsheet up and ready with all the transactions and all those sum totals at the bottom, or you've got the cloud accounting, all the bank feeds uploaded, and you've got all the entries in there. And then the other point, I'll come on to confirmation statements in a minute, But again, if you're VAT registered, and as mentioned to Alice, there will be a quarterly requirement, and most people do it quarterly rather than monthly or annually, but you can opt for monthly or annually, so the onerous requirements are less, but most clients don't normally change it, but obviously you can. And the deadline for that, so let's say your quarter end, each quarter, let's say 31st December was your last VAT quarter, you have a month and 7 days. So what I'm trying to say here is that, Alice, let's say you become VAT registered, you've got to make sure you ideally reconcile your bank, and you've made sure you've got all your invoices on file with your company name on it. Because again, a very important point as part of a HMRC rule is that if you are VAT registered and you're claiming back VAT on expenses, the invoice that you have for that expense has to have your company name on it and their company, the supplier's VAT number. Otherwise, you cannot claim it. So it's so if you were to ever be inspected by HMRC, if you've been claiming, say, invoices against your name and there's no company name on the letterhead, then they won't like that, and they may ask you to keep a refund. So just in case, Alice, you mentioned you've got these costs that you've got incurred. Just make sure the company name is on there rather than say just your name, so that if you were to claim that expense in your return, that HMRC won't have an issue with it because it's got the company name on it rather than your name as a director or a shareholder. I'm just going to touch on confirmation statements. So this is the old annual return, and all this means is that HMRC and Companies House like to know who are the beneficial owners of the company and if there are any changes. So what happens if there's no changes to the company in terms of shareholder each year, then it's basically a tick box exercise to confirm that there's no change in people of significant control of more than 25%. However, if during the period, so let's say, as Alice mentioned, she had a share raise, she had a fundraise, let's say next month, that would be an event for Companies House to be aware of, because you're increasing the number of shareholders. So normally you'd have to have a registration done. So normally if you have a lawyer involved or an accountant involved, they would actually do this for you with I believe it's an SHO1 form to confirm that there's been a change in shareholding to their share register. So that's something to be aware of. So you need to update the Companies House share register information as and when you do a share raise, and each year via a confirmation statement. So they're the main four things to consider when you are looking at having a company set up. And again, they're not too onerous as long as you plan and you're not worrying. And there are penalties. So if you fail to file a corporation tax return after 1 year following the accounting period, you get a £100 fine. If you don't pay the tax after 9 months and there was tax due, again, there'll be interest on that and also penalties and fines on that. Again, I think there's a £100 fine as well if you don't file the return. And again, a lot of clients who don't get accountants or are just not familiar with the situation, with a confirmation statement, what happens if you just forget about it and over time Companies House does not get an annual update, they do start sending quite strong threatening letters to try and struck off your company, which is not ideal, because then eventually after 6 months or a year they'll just stop the company and you won't be able to say open a bank account, or your bank account will be notified by this update on the Companies House website. So you do want to make sure these sort of small things are dealt with and not becoming an issue later on. So I'm coming up to a close on the last slide. Yeah. So before I go on to any questions on that, when it comes to wider HMRC and Companies House filing deadlines. 3, 2, 1. Okay, I'll move on. Right, so planning considerations. So I just thought I'd put some summary points out there. Just some headline points so people are aware, some key takeaways from this session. Key point here is, as you probably saw, the Excel version of doing bookkeeping is not a bad call, especially if you've only got a handful every month and you're not VAT registered. So why bother spending money and time getting the cloud set up and then getting confused with it and learning another software or having another app on your phone? But the flip side is that it's quite handy, the cloud accounting setup. If you've got many transactions, hundreds of transactions coming through, you want to use strong collaborators, strong tech such as GoCardless or Satengo or TransferWise to incorporate into your system. But also if you become VAT registered, because then it's easier to file the VAT, and especially with making tax digital, which is a whole concept for getting clients to be more digital. It's better to go down the cloud route if you're VAT registered. And again, you can voluntarily register, which you could do if you want to fast track your repayment on your expense VAT. But generally, we find that clients wait till their 85K is hit, and then they VAT register, and they claim back the last, say, 6 months expenses if they are service-based companies, or 3 years going back if they're goods-based. But one planning point, I mentioned last time about R&D tax credits, which are very, very useful for getting cash back on your R&D spend. You can only claim that on your corporation tax return. So what happens is we tell clients, yes, you can wait 9 months. So let's say your year end was 31st December, just gone, end of 2020. You could wait till 1st of October to file your accounts and file your corporation tax return, but you probably want to do that sooner, before the 12 months, because you want to claim back the cash. So you can only claim back the cash if you've got final accounts ready, your tax return is filed, so you don't want to wait 12 months. So we've had clients where he's had a June, very effective June year end, and we filed the accounts in July. So in August, he had a huge lump sum of R&D tax credit back from HMRC, and they're actually very quick at giving refunds. So it's a great cash flow advantage if you spend a lot. So let's say you've just raised funds, you spend that money, your end is just gone, let's get some more money back from HMRC through the R&D tax credit claim. And so hopefully that's quite a good planning point for yourselves. And the last point, again, let's say, and this happens a lot with clients where, and especially with COVID, where the project that they want to push forward has been delayed, or they're finding that things are just taking a lot longer than they hoped to kick off. They haven't got really many transactions. So why bother spending money and time filing accounts for the first year, for the first 12 months, if you want to just extend the accounts? You can just extend the accounts for another 6 months. And we've seen that with clients where, let's say they set up the company, well, let's do a live example. I had a client where they set up the company in 1st of January last year. COVID came and that really derailed their plans. So they had to slow down on their operations. And so the whole business model, the whole setting up the company, setting up the business trading has been delayed. So rather than filing accounts for 31st of December, because it's a 12-month year, 12-month year-end accounts, they said, well, we're going to extend the accounts to 30th of June 2021. So that way they can wait another 9 months after 30th of June 2021, rather than it being 9 months after 31st of December 2020. And it's just a simple tool in case you've got no real income flow coming in, no real R&D tax credit requirement, and you just want to save costs and time on dealing with the accounts. You can extend the year end. So that sort of concludes my tips and tricks on the cloud versus Excel and HMRC Companies House requirements. And again, just showing these slides to say, just don't stress about it. Just look around, do the research, and just plan accordingly. Good luck. Okay, LJ.
Thank you so much. I just want to check Arta's question. Were you able to answer that one?
Oh, sorry, I missed that one. My mistake.
Just the last one, which has come in.
Okay, I can see Arthur's at 11:56. Is there one before that? Oh, Kevin's one, right?
Yeah.
Do you know any good software or a Xero plugin for inventory management? I have, you know what there is? There's a thing called Xero Marketplace, and that's the very, I'll just find it 1 second for you. And what you can do is it's got a literal drop-down list of Xero. Here we go. Can you see my screen?
Yeah, we can see it.
Okay, great. Sorry, I wasn't sure. So I just typed in my mistake, and this is actually useful for anyone who wants to, even if they're not going to go down the cloud accounting route, but they've got to manage somehow using tech accounting or some sort of invoicing or anything like that, inventory. So you go to market, so it's called apps.xero.com, and you can see here, if we just type in, first of all, you've got a whole left-hand drop-down of all the different great apps they have. So, for example, if you want to have a good CRM system connection, you can actually use it here. And let me just inventory. And I'll just think of anyone that I've off the top of my head I can see if I recognise. I've heard of Unleash, which is quite good. Which is one I've heard of. So you can see there's so many you can try. And the great thing is, Kevin, is that within here, they've also got reviews. So it's a bit like Amazon, where you can see by the number of reviews, number of stars, and also how high they are, which probably could be a champion Xero staff pick. So again, this is why I like Xero. It's a very much a collaborative approach to doing business. Obviously, they're a business, you've got to be mindful of it. They're generating profits, but at the same time, they're very much a collaborative approach of how you can work together with various partners. So again, you may want to look at this, and they give you a good overview of what the actual system is about, and you can click straight into it. So, and just building up on your question, Kevin, let's say you've got another, let's say you want to deal with payroll and HR. They've got great stuff here on that, and you don't need to be Xero. You don't have to use Xero. You can just be using this particular software provider's service directly. So I'll just move on to the next question. What is a start date of an accounting period? Straight after incorporation, when you start trading activity, and inform HMRC about that. I'll just put the question here in case anyone can't see it. So what happens is on Companies House, right? When you set up a company, even if you set it up mid-month, so let's say today is 15th, right? I'm just going to show it live so people can get a feel in case people don't know. And actually, this is a good point because some entrepreneurs won't even know this, but I do reckon it actually give me a good. It's a good LG. It might be a good one where just basic stuff about how to find, how to research companies or suppliers. Because sometimes I'm so used to it as an accountant or finance person that how to research a company, how to see whether they're good credit or bad credit, or how to get a feel for how long they've been established for. So Companies House has a lot of, I'm sure a lot of you will know this, but Companies House has a lot. Oh, it's already 12:02, my mistake. We're running out of time. So I'll just quickly answer this. So let's take Marks and Spencer, right? Classic UK company. So this company was set up on the. Oh, this is not a big company actually. I'll just do. Yeah, so you can see here they incorporate on the 9th, right? So what happens? They change their accounting period. Again, not a good example. So what I'm trying to say is that if, let's say, you incorporate on the 9th of April, then your first set of accounts would probably be the month end following year. So in this case, it would be 30th of April 2003. Yeah. So let's say we incorporated today on 15th of February 2021, and funny enough, we've chosen a year which has potential leap year. I mean, February is not always the great month to choose on, but it'll be the 28th of February 2022. Yeah, and it would be 29 if I'm not sure whether next year is a leap year or not. But you see my point. It just takes the month end of the following year. It's the same month but the following year. So I think that should answer your question. I know when you start trading. Oh, sorry. Or when you start trading and inform HMRC about that. Funny enough, HMRC are informed straight away. So the minute you incorporate a company, you'll also receive a letter from HMRC saying, here's your UTR number. But then if you don't end up trading for the whole year, you may want to set up, do dormant accounts and let HMRC know, but you still need to file a tax return each year. So that's something to be aware of, that even if you're not trading, the fact that you've set up a company, you've incorporated, your obligation kicks in straight away. Okay.